S&J Company Limited. In this video tutorial we are going to be looking at cash budgets. This video tutorial is video tutorial number 1 of 2. In this video tutorial, the first one, we will look at preparing the cash budget, while in the second video tutorial we will look at doing a budgeted income statement, or a profit and loss account, and a budgeted statement of financial position, or a balance sheet. You should have a copy of the question in front of you when we're working through this. Also remember that you can pause or rewind the video at any time. We will start here by reviewing the question. So starting at the top of the page here, S&J Company Limited. So, you work as a management accountant with a firm of financial consultants. The firm deals with a wide variety of clients. One of their clients, a partnership called Sean and Jack, have submitted data for your preparation. Sean and Jack wish to form a new limited liability company in the name of S&J Company Limited. The new company is to commence operations from the 1st of July. So there's our timescale, starting on the 1st of July. The information for the report is the 1st of July to the 31st of December. So that's what we're going to do the budget for. Now here we have their plan. So Sean will put in 50,000 into the business bank account on the 1st of July. I'll be issued with 50,000 €1 ordinary share. Jack will put in 100,000 into the business bank account on the same day. I'll be issued with 50,000 €1 ordinary shares and 50,000 of debenture stock. So in this case we see here that Sean has got 50,000 euro worth of shares and Jack has 50,000 euro worth of shares, but Jack has also lent money, i.e. he's lent a debenture. Sales will be on a credit basis are estimated as follows. So there's a projection of the sales, and then we're told that if you sell goods on credit, those people are your debtors or your receivables, and all debtors or receivables are expected to settle their accounts 2 months after the month in which the goods are bought. Purchases are also on credit and are estimated to be as follows. So we have the figures there. Creditors, or payables, are paid in the month following the purchase. Wages and salaries are estimated to be 1,750 per month, payable on the last weekday of each month. Sean and Jack will each draw directors' fees of 1,000 per month, payable on the same date as for above. So just to clarify that, Sean is drawing out 1,000, Jack is also drawing out 1,000, so we'll have directors' fees here of 2,000 in total. The debenture interest to be paid half yearly. The first payment is due in December. So if we look up here, we can see the debenture is a 12% debenture. That's 12% per annum on a 50,000 euro debenture. So we'll have to work that out. Premises are to be purchased for 85,000 and paid for in August. Fixed costs are estimated to be 1,500 per month for the first 4 months, and then increase by 20%. So they'll go up by 20%, i.e. they'll go up to 1,800. These costs are payable 1 month in arrears. Equipment is to be purchased on the 1st of July for 30,000, half to be paid in July and the remainder in October. It is also to be depreciated by 20% per annum on a straight line basis. Now depreciation is a legitimate expense in the income statement, but it is not a cash flow. So the first thing we're looking at is the cash budget, so therefore we will be excluding the depreciation. And then finally, the stock or inventory is estimated to be 40,000 on the 31st of December. Now that's information we need for the income statement, the trading account part of the income statement, but we do not need it for the cash budget. It is not actually a cash movement. So, moving on down then, we'll see what we're actually asked to prepare is a cash budget for the period 1st of July to the 31st of December, and we will do that now in this first video tutorial. Then you're asked to prepare a budgeted income statement and for the year end at 31st of December, and a budgeted statement of financial position at the 31st of December. We will do B and C in the second video tutorial. So we're going to start now with the cash budget. We're going to do the cash budget in 3 sections. In the first section, we're going to identify all the cash coming in. In the second section, we're going to identify all the cash going out. Now, sometimes cash coming in can be referred to as cash inflows or cash receipts. Cash going out can be cash outflows or cash payments. And then the third bit we'll do is we look at the effect of all these receipts and payments. Now I'm going to set this up. I have it set up here. So do remember, if you want to set this up yourselves, you can pause this video recording at any time. But just to run through this, what I've done here is I've written the sales across the top. They're the actual sales figures, the actual projected sales figures. So we just go back to the question here, you can see I've taken those from note number 2. I've put them in here, across here, because it's useful to have this information in front of me. But it is not part of my cash budget. My cash budget starts here with my cash receipts. So what I'm going to do is for each month, I'm going to put in here the projected cash movements for each month on a month-by-month basis. So starting off with the share capital, just go back and have a look at that. We can see that Sean is putting in €50,000 and Jack is also putting in €50,000. And then we also have the debentures of 50,000. So what we'll have here is share capital 100,000. That's 50,000 from Sean and 50,000 from Jack. And we have the 50,000 debenture loan, which is from Jack. Now what I need to work out is the cash inflow from the sales. So we need to go back and read the question. And what it says here, all sales will be on credit, so we're not getting the money immediately, but the debtors or receivables are expected to settle their accounts 2 months after the month in which the goods are bought. So if I have a look at that, that would mean that based on this plan, the goods that are sold in July wouldn't come in July, they wouldn't come in August, but in fact it would be the money would come in September. So the 25,000 from the sales in July will become a cash inflow in September. And of course, once you get the first one right, this will follow. The sales in August of 45,000 would result in a cash inflow in October. Likewise, September's will be a cash inflow in November, and October will be a cash inflow in December. So what about these two here? Well, the 45,000 there in November represents goods we sold and haven't been paid for, and in December, same thing. There's goods we sold we haven't been paid for. So that gives us 105,000, which in fact would be our debtors, or they would be the receivables. Now we don't actually have to do anything about that because our cash budget ends at the end of December, but we just make note of that because we go to do our statement of financial position, we will need that figure for our current assets. Now, in this particular question, that is the total cash inflows, or if you prefer to use the term, cash receipts. So I'm now going to add up each month. So we can see here, the total cash coming in the month of July is the 150,000. Total cash coming in August is nil. Total cash for September, 25,000. For October, 45,000. For November, 65,000. And for December, 50,000. Okay, that ends the first part of the cash budget, the cash receipts. So what I'm going to do, I'm just going to tidy this up a little bit. Here, just looks a bit neater. And here we have the cash receipts, or if you prefer cash inflows completed. So what I'm going to put down here is the cash payments, or the cash outflows. So we've already discussed the question, but if I just go back and have a look at a few key parts and to identify my cash payments. Now note 1 or 2 we've dealt with. Note number 3, purchases. Note number 4, wages. Note number 5, Sean and Jack's director's fees. Note number 6, the debenture interest. Note number 7, we're going to buy premises. Note number 8, the fixed costs. Note number 9, buying the equipment. Note number 10, isn't a cash movement, and also the depreciation isn't a cash movement. So that actually gives me my cash payments, so I'm just going to pop those in and then find the necessary numbers. So I'm going to drop in here those items I just talked about: the purchases, wages, director's fees, debenture interest, premises, fixed costs, and the equipment. So if I pop those in there, and now what I need to do is I need to put in the relevant cash flows. I'll need to do these one by one. So let's have a quick look at the purchases. Here are the purchases here, note number 3, and it says they're on credit, and the creditors or payables are paid in the month following the purchase. So 65,000 purchased in July, the plan is that that'll be paid in August. 35,000 in August, be paid in September, and so on. So what we'll do is we will put those numbers in. I'll just put them in here. So we have the 65,000 from July won't be paid, it'll be paid in August. The 35,000 from August will be paid in September. And so on across. The 50,000 from September will be paid in October. The 45,000 from October paid in November. And the 30,000 for November paid in December. Okay, the amount that was purchased in December spills over into January. Now that's going to reappear in our balance sheet as a current liability. I'll put in the wages. Well, if I just have a quick look at the wages figures. Note number 4, $1,750 per month. And remains $1,750 per month, so I just put that in. $1,750. Writing that all the way across for the 6 months. The director's fees, well, now we discussed that. It's going to be $2,000 per month. $1,000 for Sean and $1,000 for Jack. So I'll put that in. $2,000 each month for the 6 months. The debenture interest. Now, the debenture is going to be for a 6-month period, so we'll have a quick look at that. And I'll have a look at that over here. The debenture is a €50,000 debenture, and it's at 12% per annum. So, if I were to work that out, 50,000 by 12% is 6,000, but that's for the year. So, what I'm going to do, I'm going to take that 6,000 for the year, and I'll multiply it by 6/12, or get half a year, which gives me 3,000. So the debenture interest I'm talking about for the 6 months is 3,000. So I'll put that in there, and it actually says it gets paid in December, so I'm going to pop that in there underneath December. The premises, what did it say? Be purchased for 85,000, paid for in August. So I'll put in my 85,000 in August. Fixed costs, 1,500 per month for the first 4 months, and then increased by 20%. So 20% increase brings it from 1,500 up to 1,800, and are paid 1 month in arrears. So what we have is 1,500 fixed costs for July, paid in August. August paid in September. September paid in October. October's paid in November. So that's the 4 months paid, and then in November they increased to 1,800, and that'll be paid in December. The December amount hasn't been paid yet, so again that's going to appear as a current liability. I'd probably call it fixed cost accrued. And then finally we have the equipment. So if we look back here, note number 9, the equipment we purchased for 30,000, half is paid in July, the remainder in October. So I just got to slot that in July and October. So equipment in July, 15,000, and in October, 15,000. Okay, that is all the cash payments or cash outflows in this particular question here. So what I'm going to do is I'm going to add up each month. So I will have the total cash outflows, or the total cash payments, whichever you prefer, for each month. So my total for July 18,750. August, 155,250. September, 40,250. October, 70,250. November, 50,250. And December, 38,550. Now, that completes the total cash payments, or total cash outflows. So what I'll do here is just like I did earlier, I'll tidy this up a little bit. So there we go. Looks a lot neater. So you see now what we have is, we have the total cash inflows for each month, and we have the total cash outflows for each month. This will allow us down here to work out the impact of this plan and what the cash flows actually end up being at the end of each month. So finally now I'm going to put in this final little section here which works out the impact of all these projections. And what I'm going to have is 3 rows, 1 row for the net cash flow, 1 row for the opening balance, and 1 row for the closing balance. So if I just pop them in, that's what we have. Now the net cash flow will be, for each month individually, the total projected cash receipts minus the total projected cash payments. So in this case it gives us 131,250. The opening balance, I'm going to define the opening balance as the closing balance from the end of the previous period. So we're starting here in July, so the opening balance will be the closing balance from the 30th of June. The business only started on the 1st of July, so the opening balance in this case will be 0. So the closing balance is 131,250. Now that closing balance at the end of July becomes the opening balance on the 1st of August. Now in August, the projections are that no cash will come in, and they're planning to spend 155,250. So therefore I'll have a negative net cash flow of 155,250. Now we had 131,250 cash on hand, but that means that based on this plan, the cash balance at the end of September, at the end of August, will be a negative 24,000. And so the negative cash flow figure of 24,000 becomes the opening balance beginning of September. So for September, 25,000 projected to come in, 40,250 projected to go out, which will give us a net negative cash flow of 15,250. So we have a negative cash flow of 15,250, and that will be added to the negative 24,000, which brings the net negative cash flow up to 39,250. So this is rolling forward into October, minus 39,250, and the situation is getting worse in October. 45,000 projected to come in, 70,250 projected to go out, so that gives us a negative 25,250. So now the rolling total becomes a negative 64,500 rolling into November. So starting off the month of November with a negative 64,500. Now in November things are improving a little bit. 65,000 is projected to come in, 50,250 projected to go out, which gives us a positive figure of 14,750. So in other words, there will be a net cash inflow. Now that will reduce the deficit down to 49,750, which goes into the beginning of December. So starting off December with a negative cash figure of 49,750, and again things are improving a little bit in December. 50,000 projected to come in, 39,550 projected to go out. So again it's a positive net cash flow for the month of December, which means the overall deficit has reduced to 39,300. Now, this is all a little bit messy here, so if I just tidy it up, we can see the negative cash flow at the end of December of 39,300. Okay, that brings us to the end of the cash budget. In video tutorial number 2 for S&J, we will look at the income statement and the budgeted statement of financial position, i.e. the balance sheet. Thank you.